see it here on Zoom, of course, too. We'll wait just a few more minutes as people are joining. All right. Welcome, everybody. Unfortunately, for those of you who are just joining, our speaker did cancel today. And so today is just an open discussion group. And so if you have any thoughts about a particular investment or the current investment, climate, or if you want to discuss, how you're setting up your investments in an LLC or tax deductions on real estate or oil and gas, in solar, I actually have booked now a person, Mark Perlberg, who this will be his third time coming back, which might make him the most the person who's had the most time speaking in this club. He's going to come in, I believe, and talk to us about solar credits. That'll be coming up. We don't have a scheduled date for that yet, though. But today's the day to ask questions and just have a conversation. So I will leave it there and we'll let people enter. And if anybody has a topic, feel free to bring it up.
Hi, I have a question. Yeah, my name's Eric. This is the first meeting I've actually joined, so thanks for inviting me. The one thing that I've been sort of exploring, which I haven't found an answer on yet, is any tax strategies to offset W-2s.
Okay. Yeah.
So, yeah, I mean, I've done some searching online. I've talked to a few people that I found through Facebook, which I have no idea where they're coming from, and I've heard some ideas, but haven't really found anything solid that sounds promising, right?
Okay. Yeah. I'm going to open that up to the group. And I will say that we have had speakers. Actually, you know what? The first thing I'm going to do in here is I'm going to point you towards our existing YouTube channel. We have a lot of talks in there, and I'll actually point you towards some of the talks that have to deal with offsetting your W-2 income, or if it's a severance package, offsetting that as well. So let me just drop the YouTube channel in here for your reference. There are creative ways to be able to offset your W-2 income. And so if anybody here wants to go before I go, feel free to bring up what you're doing. And Eric, welcome to the group here. Normally we have a speaker come in. And so if you look at the YouTube channel, you're going to see 254 videos of different speakers that have come in. And they always have an interesting topic. Most of them are doing it full time. I mean, the group can speak up here. I personally think they've been pretty good, but I've invited all of them. So maybe a group testimonial on what they like and what they don't would be good here too. I'd love to hear what you don't like also. But today is just going to be a discussion group because our speaker canceled at the last moment. I woke up at 6 a.m. this morning, went down, found an email saying he wasn't coming in.
Okay, no problem.
I don't know about others, but Eric, on this topic, the main buckets of things I've observed are, you've got to figure out a way to get you and or well, not you and or it's got to be you. If you're the W-2 earner, your spouse needs to become a real estate professional, and then you can, there's some tax advantages to being able to do that plus offsetting W-2 income from that, along with investments, right? So that's one bucket, and my observations is that there are several people I've read and watched that have said it's way easier than at least what my CPA says it, legally really is. So, definitely do your homework there. The other ones would be things like what Daniel's brought up before, like oil and gas, where you've got these, exception carve-outs that allow you to take the depreciation across from passive to active in that particular investment type, or like what opportunity zones, or in a few other things that are like that have exceptions.
Mhm. Yeah, I've heard of something similar to that with solar as well, like solar farms. But I just haven't figured out a way to sort of where to get started on that, right? I mean, other than I think there was somebody that I'm in California. The person that I talked to was some other state. I can't remember where off the top of my head, but they basically said, yeah, we'll set everything up, but we need like $15,000 down from you. And without knowing more about it, I was hesitant, to do something like that. Um,
Okay. Well, I can think of 5 different strategies that I can go through. And Glenn, you mentioned oil and gas. I'll do that last. I've actually, I mean, if people want to dive into it, we can or can't. I'm putting together a little presentation on reducing your W-2 with oil and gas because it's confusing enough and different enough than real estate that I've got a lot of questions on it recently. So, but the first way, and if you go back and look for Michael Hazen from Vistia.com, and actually, as I recall, he was one of the speakers who asked me not to record his video, so you probably won't find it up on YouTube. But his strategy was land conservation easements. That's strategy number one. That particular strategy has been reducing over the last 2 years. Instead of 100% deduction, it was at 80 last year, and I think it's 60 this year. And some of the people that have been doing land conservation easements have been changing quite a bit. But that's a really, really strong way of getting your W-2 income down. And I'll circle back around and talk more about each of these. The second way that I know is really popular is you can reduce your taxable income through Airbnbs or short-term rentals if you qualify for the under IRS code 469, which is the passive activity loss and loss statutes. So, and we can go through and talk about how to qualify for that. But that was actually one of the first ways that I reduced my taxable income, and I can go through and describe that. The upshot of that was I put 80,000 into an investment in a property with 2 other partners who each also put in 80,000, and I ended up getting a $200,000 tax deduction out of it. The other 2 ways, you mentioned one of them, solar. And I've been very interested in this. I've been researching it recently, although I'm just scratching the surface now. I'm trying to find a speaker that will come in and speak about it. My CPA, actually, Mark Perlberg, recently did a talk about solar and gas, not solar and gas, solar tax credits. And so I want to get him to come in and talk about it more. My impression is that the income and the investment side wasn't that great on it, but it did give you good tax benefits.
Mhm.
And then it's interesting. The more you look at different types of funds, the more you realize that each of them have their own carve-outs within the tax law. So another way too is our speaker today had a fund where he funds indie films. And he had some really good names on there. He's apparently doing the Johnny Depp documentary, and he has some of the actors from Dr. Quinn Medicine Woman, and he had a good list of people that were there. Uh, Unfortunately, he canceled on us, so he's not here today. And I was looking forward to hearing about the tax benefits of that. My understanding is that they were actually instead of tax deductions, they're actually tax credits, and so you can even potentially have larger tax credits than you do income, meaning you would get a return in that case. And then the fifth way is oil and gas partnerships. These have very good income and very good tax deductions. A lot of them will let you reduce your your adjusted gross income by 80 cents on the dollar for each dollar that you put into the investment. So you not only buy the investment, but you're also getting a big tax deduction on the other side. So if any, now I don't know much about indie films and I don't know much about solar credits, but if you want to talk about any of the other three, I would be glad to go into that. Or yeah, Prolet says and wants to hear other people's experiences on oil and gas. So I want to open it up there. And then Rodney in the chat is also mentioning art. And I have invited some people that do art funds into the group, but I haven't gotten a response back from anybody yet. So I am looking for that. If anybody knows a contact that has an art fund and wants to come in and present on it, please let me know.
Yeah, I'm actually really curious for other experience, and I think last week I had asked you in message, like, what is the experience with even the oil people that are in the fund? Because my experience so far with oil has not been what I expected to be. I mean, great for the tax part, but not for the rest of the part.
Ah, what happened? Did they not hit oil, or did the price go low?
Oh, no, the price is actually down now. The price is not in a great place right now for oil. But one of the projects really didn't, it was a refract project. That one didn't actually go through because there were problems when they tried to refract. That was not much money commitment, so that was fine. My other project, in theory, like with oil, you're expecting, in theory, to have like a full return of your initial investment within the first 2 years. Right now, it looks like with that one, it will be at least 4 years until
Okay.
the initial return of money. The other
Do,
one was a
do you
fund.
mind if we ask who you invested with, or do you not want to share that? You can keep it
Uh,
private if you want to.
I would think I would keep it private.
Okay.
Until I'm done with a project, I don't usually like talking about people.
Yeah.
Um, but so that was two projects. The problem with the second one really was I think the fact that how they drilled was different. So they're hoping to have a longer, more consistent flow versus the spike that you get in the first 2 years and then it levels off. The third investment that I had done is a fund. So it's been now like 2 years almost, and they still haven't finished drilling all the wells, and the fund is not completely deployed. So
2 years and they're not done drilling?
yeah, so they're finally getting to 8% annualized return, which is like, yeah.
Okay.
And yeah. And my last investment, that one was like a very weird one because after I invested, the company decided to go public, and I'm still waiting to hear out what the hell is going on with that. So I have technically some shares in some company that hopefully will go public.
All right.
But I have
I pulled up the chart of oil here currently. We're at 71 for Brent crude. We're at $71 per barrel. So it's probably right in the midpoint of the last 25 years or so, it looks like.
so I look usually at WTI because that's like a lot of it is in Texas, and WTI is what the pricing is for that.
Okay. Okay. All right.
Yeah.
Well, I could talk about so Eric, did you have a particular interest in any of those strategies that I mentioned? Um,
I do actually. Anything that has to do with, being an active participant in, to where I can offset a W-2, income.
okay.
That's kind of what I'm targeting. But yeah, so I'm open to yeah.
Okay. I'll just go through all three that
Yeah.
I know something about.
Okay.
Hi, Daniel. This is
Yeah.
Kylas. Yeah. So, as you described, my spouse is not working now. She's retired from Intel. So, I was interested in knowing about that Airbnb or those kind
Okay.
of opportunities.
Mm-hmm. Well, and I guess the fourth or sixth way might be, to qualify as a real estate professional. And once you qualify, if you or your spouse qualify as a real estate professional, you get all the passive activity that you get with real estate then counts towards your active income, and it provides you with a big tax deductions in that respect. But the first was oil and gas. I'm not oil and gas. It was Vistia. Is it Vistia.com? I get that right? No, I don't think this is it. Maybe it is. But the speaker's name was Michael Hazen. And the basic idea here with land conservation easements is that back in the 1986 tax code that was passed, 1986, there was a section that talked about land conservation, and the whole idea was that the federal government wanted to make it so that it's attractive to purchase land and to conserve it in perpetuity. And this has become a really big tax shelter for a lot of people. But the basic idea is that you purchase the land, and oftentimes it's done as part of a group investment. So in my particular case, when I did this, I was part of I think it was a $66 million purchase of land. And you have to commission in this particular case, it's syndicated, which just means that a group of investors pool their money together in an LLC. The LLC buys the land. And the idea is that you have to get a third party, and you as the investor aren't going to be doing this. The person who's managing the project is going to do this. That person has to get a third party independent appraisal of what the language is highest and best use of the land is. In my particular case, it was a rock quarry. And so they commissioned that study. They determined what the value of the land would be if it was a fully developed rock quarry. And then you go to all your investors and you have to have a vote. But as we put together our investment, when you signed up for the investment, you had to you had to sign a proxy agreement that you were going to vote a particular way upon coming into the investment. So all the investors going into the investment were going to vote to make this a land conservation easement. And so the land conservation easement, once you vote to do that, what that means is that the land is preserved in perpetuity, to be undeveloped, no structures, no development of any sort on it. It's to be kept pristine forever. Even if you sell it to the next person, they're not allowed to develop it. And if they sell it to the next person, they're not allowed to develop. So it's to be kept forever undeveloped. And in exchange for doing that, 4 years ago or 3 years ago when I did this, you actually got a 5x charitable deduction, which could be counted against your adjusted gross income. So for every dollar you put in, you got a $5 charitable deduction out of it, and that would offset your W-2. So if you're interested in that, go look up land conservation easements. The 5x, I believe, is at 2 to 2.5x now. I haven't looked at it in a while, but it's reduced significantly, and so a lot of the people that are doing these types of strategies have shifted their strategy somewhat. So if you're interested in that, go look it up and go educate yourself on that topic. We should probably bring another person in to talk about it, but they all, due to SEC regulations, don't want me to record their videos, which I guess is good for the live group, but not good for the people on YouTube.
Mm-hmm. And just from a high level, just question on that. So whatever money that you invested in that goes towards this land conservation. You don't ever recoup that, but the benefit from your side is that you get that 5x write-off.
Yep.
Okay. Yep. Understood.
Is that write-off just for the first year, or is it for every year going forward that you have that property?
Almost all depreciation, you get the majority of it in your first year.
Okay.
And then there's smaller amounts that you get in next year's, but you get like 80-90% of it in the first year.
Okay, thank you.
And there are some rules around that actually. So you're only allowed to reduce your taxable income by up to 50%, and it had to be used within a 15-year period. So if you don't use it all in the first year, it can roll over to the second year, roll over to the third year, roll over to the fourth year, but it couldn't roll over past 15 years. And those were the rules at least about 2 years ago, 3 years ago when I did this. The Now the second strategy was short-term rentals and passive activity losses.
Hey,
So
Daniel, can I jump
yeah,
in on the conservation easement?
please.
So you guys, it's a 2.5x multiple, right? Is the limit, which means if you're paying more than 40% in taxes, you'll make a tiny bit back. Up to 40%, you're not going to make anything back. And I would not recommend doing this anymore.
Now,
The
I know
IRS
that
is
the people that are doing this
absolutely-
have changed their strategies to other structures. Are you not recommending those, or are you not recommending the land conservation easement?
Anything around the conservation easement, unless you're buying the land yourself, right? And there's no syndicate, then you're probably okay. But if you're going as part of a syndicate, I would not recommend. And if anybody really wants to talk to me, right, ping me privately, and I'll let you know.
Did you do one recently, or something,
Uh,
or look into it recently?
This year, no. Last several years, yes. But this year,
Okay.
no.
Okay, great. It's Ashish Gupta. He also has a talk up on YouTube. So you can check that out as well. Oops, I can put this down. The second thing you can do, and there's a lot of talk about this, and there's a lot of debate on whether short-term rentals are a good investment at this point or not. So people have different experiences there, and of course it depends on where you are and what is around you and what's driving people to be in your short-term rental. In my particular case, I had two friends. We created a partnership. It was three of us, 33, 33, 34. And yeah, I agree with Prolette. It is oversaturated in a lot of places right now. And so I would personally be careful about short-term rentals. But short-term rentals, if you qualify for the passive activity losses, which is IRS 469, the section 469, and they had a variety of ways you can qualify for it. I think there were 8 or 9 ways, but the two that were the most common were if you put in a total of 500 hours in a year on the property, and or if you put in more than 100 hours and you put in more time than anybody else, including your cleaners. Those were the two most common ways to qualify for it. But basically, for that particular property, instead of counting it as passive income, you can count it as active income. And so what I did in my case was it was 3 of us, and we formed an LLC and bought a little house up in Idaho. My 2 other friends are active skiers, and so we bought near Schweitzer Mountain by Sandpoint. And I came to them and said, hey, my wife and I, we would be glad to manage this. And so my wife and I, we both do all of the if we need to go up and change things around in winter and summer, we usually go up twice a year. We speak to all the people that are looking to rent it out and manage and coordinate those calendars. And the property management there is anywhere from 15 to 20% if you're going to outsource it for a short-term rental. There's probably more expensive and cheaper places to go, but it's roughly that. And in the LLC, what I said to them is, I'm going to waive the property management fee if in the operating agreement you assign my wife and I all the depreciation. And then we split the income all 1/3, 1/3, 1/3. So they were actually already real estate professionals and had a ton of tax deductions. They weren't looking for the tax deductions. I was not at the time. I was working at Intel. And so I got all the depreciation assigned to me. And with that first year depreciation, I went and got what's called a cost segregation study to accelerate that depreciation. And it ended up being a little over $200,000. It was actually a 200,611, I believe. So, and we put 80K in. So that was a great way to reduce our taxes too. Anybody else out there have experience with qualifying for that? I think that might probably be the most common way that people, I would guess that would be the most common way in this group that people would qualify to reduce their W-2.
Yeah, I don't have any personal experience, but yeah, I was looking into that same aspect, doing a short-term rental, trying to get the 100 hours in and managing it myself and doing a cost seg study. I just haven't, I don't know anybody that's done it until today. I guess you're the first person I'm hearing that that's done that.
Yeah, I just contacted my CPA. It cost me, I want to say $1,200 for the study, and I ended up with a big tax deduction from it.
I know somebody who has done also the loophole where you do it and basically, obviously, try to do it kind of towards the end of the year, and you do it as short-term rental to qualify for that year, but then the next year you convert it to like a non-active participation. So you participate in the first year, but after that you offload it to property management. You can even convert it to a long-term rental, but as long as the year that you buy it and do the depreciation, you're active, then you can still do it. That's the whole Airbnb loophole. So I know somebody who has done it twice, and it seems to work for them, but it's definitely quite a lot of planning.
Because I've done this for over a decade, and it works. You just, if it's a short-term rental, it's treated like a motel, so you can write off any losses. And if you have a profit and you happen to have kids that are actually doing something, you can pay your kids as well. And that's, I think you can pay like 12,500 if they're under 18. And the advantage there is the kids don't pay any self-employment taxes. So if you can find the right price for a house that actually can rent out, then it could be very lucrative, right? And that's the challenge now.
Mm-hmm. And does anyone have experience managing that sort of remotely, or were those Airbnbs close to your current location?
Mine's 3 hours away. And the trick is, in the beginning, it takes time to set it up, to put it on the VRBO, Airbnb, etc. Taking pictures, finding a housekeeper. I think a housekeeper is probably like the key thing, finding somebody reliable. But once it's running, it doesn't take a ton of time.
Okay.
The other thing to look out for is a lot of counties require you to have a person designated as a local representative that they can contact in case of emergency. So you need to check with either your county or your city to see what the local regulations are. And then, of course, a lot of cities will permit them as well. So if you're buying in an area that only allows a certain number of Airbnbs, you need to be aware of that, and get yourself into the permitting process or figure out how long it's going to take to get that.
Right. Yeah.
One thing that happened to us is the area that we bought it in. Originally, the county said we could have a maximum of 12 people in our place, and this last year they just changed it to 8. So it's kind of irritating when local groups change the laws like that.
Yep.
Hey, one pro tip I would provide, which I learned this year, was, most of these places, if you're not in a place like Daniel's in the winter, like ours rents in the summer, but in the wintertime, there's hardly anybody there. So we converted from a short-term to a medium-term rental, and we put it on this website called furnishedfinder.com. And in the wintertime, we almost always get somebody who has an insurance claim, and the insurance company is paying for their stay. So it's a good way to sort of get additional revenue in the months that you're not getting anything.
Is this it right here, Ashish? Furnished Finder?
That's the one.
All right. I'm going to check that out too, because our particular place, we have a high in the summer and a high in the winter, but spring and fall are our downtimes. And we usually do a midterm rental in November, but only because we happen to know some people that we contact every time in November for it. But I'm going to check this out.
Yeah, so insurance companies tell me that they have water leaks are the biggest thing that they place people in temporary housing for. So you'll be amazed at how many water leaks, either from frozen pipes or the fridge pipe bursting or toilet pipe bursting, right? Mm. And those usually take 1.5 to 2 months. So insurance companies told me that if they have a over 3 month stay, they'll put them in a long-term rental and bring in furniture to rent. If it's less than 3 months, it's more economical to go through this site. like a furniture rental.
Yeah, and I would actually say if people are traveling for extended time, check Furnish Finder too, other than Airbnb, because the pricing is much cheaper. I use Furnish Finder also to post. I have a midterm rental that's part of my duplex, and it's much more like it money wise. It makes more sense for me because with Furnish Finder, you basically, as a host, you pay one fee. I think it's now $200 for the year, and that's it. But you are the one that manages everything. So you need to worry about your contracts with the tenants. You need to worry about all of the communication. They're basically just like, hey, post your property there. They have some services to try and do like contracts with the tenants, but frankly, I didn't find a contract very good, so I just use my own.
Good for you.
So.
Anybody else have thoughts here? Is this something that if I were a traveling nurse or a doctor, I know that Airbnbs around hospitals or short-term rentals around hospitals also seem to do fairly well.
Yeah, this is very popular with nurses. Yep.
Well.
Yeah, I think it started with nurses, but I can tell you well, first of all, I'm hearing that depending on where you are, the travel nursing is not doing as well right now. A lot of the travel nurses are getting paid way less than what they were during COVID. Obviously, during COVID, everyone had like a lot of demand. So now I was reading about them complaining that they're not getting as much subsidies around the housing. And I would say easily in the last year, I think I've only had one nurse I have places. I've only had one nurse. Everyone else has been more of like traveling people that either are moving to the area or people that are just like digital nomads almost, that are just going to different locations and just being there for 3 months.
Yeah. Yeah. All right. Anybody else have thoughts on this? Okay. Then
maybe one other so I'm kind of looking, I'm in Folsom, California, trying to find a good location to invest in for an Airbnb. And I was looking in Tahoe, but that seems to be sort of already flooded and they have a ton of regulations. So I don't know if anybody has any recommendations on where else to look.
Austin is also not a good place, just like, you know.
I suppose that you can always go to a map like this and see where the density seems to be high and then kind of zoom in and research those areas to see what would be your business strategy in that particular location.
Mm-hmm. Okay.
Well, for Airbnb, people use also AirDNA.
AirDNA,
yeah.
Or there is some other service that in theory can tell you. I think they're both all paid, but yeah. I know so many
Go ahead.
markets are saturated.
I don't really like AirDNA for finding a area to invest in, because the way their business model works is they actually sell you the data for a particular location. So you have to go and buy the data for a location, decide yes or no, go around, buy the data for another location, decide yes or no. And I didn't find it to be the best, most cost. I mean, once you found an area, it's got great data. But I don't know, was that your thought too, or did you have a different experience?
I frankly never used it. I know that some people do, because for me, I wasn't looking for somewhere to invest. It's more like I have a space and I was trying to figure out what works for me. So yeah, I don't have a first-hand experience.
AirDNA is really good if you have a Airbnb house and you want to know what the pricing fluctuations are over time. They do a good job of furnishing that type of info. All right. Anybody else before I go over the major deductions in oil and gas? Okay. So with oil and gas partnerships, what these are is how these come about are when the federal government opens up land for drilling. Federal government will have an auction, and the first people that rush in tend to be speculators. And so these speculators will go and they'll buy up, 10%. You can buy oil leases in percentages. So you can buy 10% here in this area, 10% of that area. And they'll go buy up hundreds of acres, 10% of hundreds of acres. And they're usually fairly cheap, $100, $200, $300, $400 an acre, something like that. And then the oil companies will then come in and purchase the remaining amounts. They don't rush in as quickly as the speculators tend to. And so the oil companies see the speculators obviously as kind of a nuisance. They're holding 10% of the oil lease there, and they, have a whole bunch that isn't good, but they have some that is good. So the oil companies will come in and they will do their own evaluations. They'll buy up 90% of whatever they buy up there. And excuse me. And when the oil companies purchase that land and or create a environmental report saying that there is probably oil in this area, the value of that land goes way up. It'll sell for several $1,000s an acre at that point. And so that's how these working interest, or at least how the little guys get into the working interest deals, is that once the land goes up in price, the speculators don't want to be a part of developing that land. They're just in it for the price increase. And so the speculators will then turn around and sell it to oil and gas partnerships. And the oil and gas partnerships will hold that 10%. And when the oil company develops that particular spot and puts a couple of oil rigs in, they will say, okay, small guy, you own 10% of this particular oil working interest, pay us 10% of the expenses, and we're going to give you roughly 10% of the income. So that's kind of how an oil and gas partnership works for the passive investor. So if you're interested in this, you go find people that have oil and gas deals, and they're out there and they vary in quality quite a bit. Some are good, some are bad. Some of them are bringing investors into the deal before it's known if oil is discovered. Some are bringing them in, after or shortly thereafter. So there's different areas and different risk points you can get into the deal at. The major deductions are the tangible drilling costs and the intangible drilling costs. Intangible is actually the largest one. And that's all the costs that you cannot recuperate. Let's say you're going in and exploring for oil. It takes labor, it takes machines. The price of the machine is not included in the intangible drilling cost, but it takes fuel, it takes lubrication for the machines, it takes maintenance contracts, it takes all these things that you're not going to recuperate if oil is not discovered there. And then tangible drilling costs are another bucket. Let me come down here and get you the. So these include more of the machinery and things that you can recuperate and use again at a different site, basically. So and then depletion allowance. Depletion allowance is a special tax incentive for smaller producers. And the basic idea here is that the smaller producers, if they refine less than 50,000 barrels of oil a day or 1,000 barrels of gas in a day, then they're allowed to exclude 15% of the income they make from taxes. So those are the three. It's the tangible drilling costs, the intangible drilling costs, and the depletion allowance. And the nice thing about this is that according to the non-passive, so again, section 469, the same section that talks about short-term rentals. And actually, I had it open up here. Yeah, right here. So I tend to use Cornell law whenever I want to go look up a particular area. And I'm not a lawyer. I'm not a CPA. I'm an investor. Go consult your lawyers and CPAs. But I do like to go actually, try to find where in the law it is and read it for myself. So so if you're gonna go to 469 CB, you'll see working interest in oil and gas. And it says the term passive activity shall not include any working interest in oil or gas properties, which the taxpayer holds directly or through an entity that does not limit the liability of the taxpayer with respect to such interest. So limiting the liability, that means if you're not an LP, a limited partner. So in these deals, people tend to come in as general partners. They'll take the tax deduction in the first year because that's when most of the tax deduction is given. And then oftentimes they're converted to limited partners later on. So that's fairly common. All right. And where was I here? So this does count against your adjusted gross income. It reduces your taxable income. So if you make $100,000 and you invest 30, this would reduce that 100,000 by a percentage. And I found this really good example on this webpage. See if I can pull it up here. Cerebral Tax Advisors. It's a CPA firm, but they had a really good article, and this is the walkthrough that they gave here. So imagine you invest $100,000. In the first year, you get 80%, and that is, from what I've seen, a common number. 80% of that goes towards the intangible drilling costs. You can write them off in the first year, so you have an $80,000 deductible expense that goes against your ordinary income, or it actually goes against your adjusted gross income. So that includes your capital gains income too. Additionally, 10% of it's part of the tangible drilling costs, so all the equipment that can be reused, and that can be depreciated over a standard equipment depreciation timeline, 7 years. And then if you're in a 35% tax bracket, probably a lot of people in this group are in the 37.5 or the higher tax brackets. That means that you will reduce your taxable income by 80,000 times your tax bracket, and you get a deduction of whatever that tax amount is in the first year. Here's another breakdown of that. This one's frankly a little simplistic. 65, 35. The CPA for that actually is for the LLC that holds the working interest. You'll hire a CPA in order to create all the investor returns, not you as the investor, the person running the deal will. And their CPA is going to create a K1 form, which tells you, just like in real estate or any sort of partnership return, exactly what your active income or losses are, your passive income and losses, and a variety of other boxes that are on that form. So the idea here is that if you put $100,000 in this particular case, you're reducing your taxable income by around 70. And I'll share these examples. Actually, I'll just throw them into the chat right here. These are good articles I found on the topic.
So question though, has anyone here been through year 2 of oil? Because that's actually like also the bigger question.
I'm sorry, I couldn't quite hear. Any 2 of oil?
Year 2.
Year
So
2 of...
great. Yeah, so great that year 1 you get a lot of the tax deduction, but then the well starts producing and now you're getting the income from it. I saw kind of, I personally haven't been at year 2. That this year will be my year 2 where I get the income statements. And now what is the treatment of that? Because I have seen conflicting information around it being reported as self-employment income. or being reported as like, what is the tax treatment of that? Because now, especially if it's an oil well that's going to return its initial investment in 2 years, let's say it's 100,000, you're talking about 50,000 each year. Now you get taxed on that. So it's kind of almost like with real estate, where unless you continue investing in oil, then the next year you're going to get taxed.
Yeah. Yeah,
I don't know.
I think of the tax deduction and the income as kind of separate components. You get them at different rates, right? So you front load the tax deduction, and then if you don't use it, it rolls over. But if you do use it, it's just in the first year. And you're the way I tend to think about oil wells is kind of like a soda can. Once you pop the top, the maximum amount of pressure in the oil reserve is at the beginning when you drill. And so the oil comes out, and you can see this in historical production reports. There's always I kind of geek out on it because it's a really nicely defined exponential curve, right? It's the highest amount of income comes at the beginning, and then it exponentially comes down asymptotically to the point at which the income drops below the expenses that are needed to maintain the oil rig. So yeah, you'll get the highest amount of income at the beginning, and you'll get the largest tax benefit at the beginning, but they may not necessarily overlap, going forward.
Yeah, so if the next year you make $80,000, I mean, 15% of that $80,000 is going to still be tax-free, because that's the other oil thing that you have as part of it. As part of a production, 15% of production automatically kind of get benefits for. But I was just wondering if anyone here or you have gotten the year 2 statements, like how is your income treated in the K1? Like, is it reported in self-employment? Is it reported into the some kind of like a business income? I wasn't sure what the treatment of that income is.
So, speaking to the deal that we have open in this club, we convert everybody over to limited partners, and so it would be passive income going forward. Is that?
So business, box 1?
No, it'd be the same as real estate, passive or rental.
Really?
So year 1 would be active, year 2 would be passive.
But even if it's passive, it can be either business or real estate. I really doubt it's real estate.
Yeah, it's considered let me pull up a K1 here. Actually, I don't know that I have one redacted I can pull up. So yeah, it would probably be treated as business income because you're selling the gas and reaping the benefit from it. All
so
right.
Daniel,
Yep.
for an initial first step, somebody first getting into this, where would they go first to find where to invest?
Well, so I only have experience with a couple of groups here currently. Basically, it's a lot like real estate syndication in that you have to go and find people that are running these private deals, right?
I see.
And like I mentioned, we are currently working with one, and it's active, and we are raising capital for it right now. But I can point you to a few others too if you want.
Okay, sure.
Actually, the speaker that was supposed to come in today, his main business is oil and gas, but he had this indie fund also. But I'll send you what we have, and I'll send you a couple of people that I've also researched.
Okay, that'd be great. Thank you.
Send me your email address.
Oh, right. Do I just paste it
for
in the chat or something?
Anybody in the group that's interested too. Ashish, I wanted to ask you, did you have any other tax strategies for reducing your W-2 income? I know you're active in this.
So this year I was going to look at Valor, and I put the link in the chat.
You were going to look at what?
Company called Valor, VALUR.
Oh yeah, you told me about them.
So the way this was, because well, you'll have to. It's sort of hidden. You got to type in Valor solar projects. Oh yeah, try the bottom left. You have it in there,
Okay.
Rebecca.
Oh yeah, from when we were talking earlier.
Yeah. So looks like they're all sold out. But if you go to availability, just go to on the right hand side.
On the right hand side.
Yeah, there we
Right
go.
here?
And then go to all.
Okay.
So my understanding with this, let me try and explain how I think this works, right? So we have solar on our roof, but we got like a 30% tax credit and maybe like a 2 or 3%, 5% state credit. So it still costs us 65% of what we paid. But if a nonprofit or a school wants to put solar, well, they don't care about the tax credit because they don't need it because they're a nonprofit. So my understanding is what these guys do is they will go find stores, convenience stores, that don't require the tax credit, and they'll put it up there. But then you, as an investor, gets all the tax credit. And they've got this model called what's called a flip partnership. And what flip partnership does is they basically leverage it. So if the solar is going to cost $100,000, you put in 100K, but then they'll also get a bank loan for another 100K. And the bank doesn't care about the tax credit either. So you get the tax credit for all of it, which is why they say 35% estimated ROIs, right? So for 100K you put in, you get 135K back. And it's kind of a cool, from a risk standpoint. It's cool because it's de-risked because all of it is tax credits. There's very little of it that comes in the form of income.
Okay.
So I talked to this company last year, and yeah, I thought it's a complicated model, but it's a complicated business, right? And it seemed interesting. And you can see there's some legal fees involved in there as well. But this is what these guys do, right? And they sell tons and tons of them. So we should have them come in, right? The problem is these guys are pretty sophisticated, so they tend to talk above people's heads sometimes.
Okay. All right.
And who knows what's going to happen next year? With drill baby drill and solar tax credits, who knows what's going to happen to the new administration?
True. This kind of reminds me, I saw a real estate deal where private equity firm, a REIT, was coming in and buying the majority of the equity, but the rest of it was being syndicated out. And because the REIT was a REIT and they had to distribute their income, they weren't able to take the depreciation. And so the people that came in on the syndication side actually received that depreciation, and it was great. For every dollar you put in, I think you got a $1.20 depreciation coming out of it. It was pretty nice. Some creative deals like that, it can have some really unexpected benefits.
No, yeah. So if anybody else has like a solar, a way to provide this, I would love to hear about it.
Yeah, me too. Well, so I'm going to reach out to them. I believe I've reached out once to them, and I didn't get a response back on whether they wanted to be a speaker here. So I'll reach out to them again.
So if you go to detail model, right? So now, okay, so here we go, right? So the purchase amount is 127, and of course, this assumes you're in the highest tax bracket. So if you're not, then your benefit's going to be a little bit less. But you get $87,000 in federal investment tax, then you get depreciation, state depreciation that assumes California, very tiny project income, right? Which is good because you don't want to be hoping to get a income for the rest of your life for 20 years, right? You want it to cut off very quickly. It reduces the risk. So the total returns, if you're in California, the highest tax bracket is 188.
This is over how many years?
If you scroll down, I think it's like 3 or 4 years. Yeah, go to cash flow. 5 years.
Okay. Yeah. 5-year on the cash flow, 2 to 5 year on the depreciation, it looks like. Although it's
It says it will return revenue for 5. It will return
Yeah.
revenue for 5. Doesn't
Very
say.
minimal, right? You see it's $1,200. It's very minimal. Which, frankly, as an investor, I like that, right? Because I'm not investing in this hoping to get a big return for 20 years because it may never happen. I'd rather just cut it off.
Yep.
But do they return your capital?
The capitals, they don't. The capitals return in the form of tax credits and depreciation.
So are they actually purchasing and installing solar with your capital, or what are they doing exactly with your capital?
My understanding, this is a family office that started doing this like a few years ago for their own internal investments, and then they found it to be so lucrative they took it external. And then this company Valor is contracting with a bunch of these family offices that have these deals.
Very cool. Very cool. Anybody else have any thoughts? We've got 2 minutes left on saving on your W-2 taxes. We've gone over a bunch of strategies here, so this will be a good episode. I'll create a couple of LinkedIn posts based on this. All right.
I don't know if you saw my comment in the chat, but funny, like literally yesterday I was at an oil rig that is drilling here in Texas. It was an amazing experience. If you guys are anywhere located where there is oil drilling going on, try to find a sponsor and go and visit their operations. It's very fascinating experience.
Hey, so Perlette, about 3 years ago, I actually did a whole talk on 1031ing into syndications. It's an interesting topic. I can send out a link to it also, but basically you have to create a syndication, and then you have to create another entity that does the 1031 exchange, and the two entities have to be tenants in common. Basically, each owning tenants in common means they both have 100% ownership of it. And so what it tends to boil down to is there's an extra $50K worth of legal fees when you're doing a syndication that accepts 1031s, 50K-ish. The lawyers make out well. And so for that reason, the syndicators won't do it unless you're bringing in, minimum 500, but more like $1 million of equity.
Yeah, it's not for me. Somebody was asking me, and I figured I'll ask if anyone had experience with any sponsors that are doing it. Because I don't know, for me, the DSTs, like the returns are so small that at some point you have to actually evaluate, is it worth paying the tax, right? And going for something better. So,
yeah. Melissa Ormiston is also on our YouTube channel, and she talked about doing 1031s just in general, and DSTs. So DSTs are Delaware statutory trusts, and they tend to be invested in by very large institutional investors. They get basically for capital preservation. You're getting 2 to 3% return maybe. But there's a variety of DSTs, so there are more, and there's some that are more, some that are less, but it usually tends to be less. But you can 1031 exchange in and out of them, which means that if you can't identify your 3 properties that you want to declare in 45 days for the 1031 exchange, if you can't find 3 properties or 1 property, or if you can't make the exchange within 180 days, you've got 45 days to identify the properties, 180 days to complete the transaction. DSTs are a way that you can change into something temporary and then change out of it. And Ashish, I love your idea of donor advised fund. Yes, I want to get a speaker to come in and talk about donor advised funds as well. So that is on my list as well. If did you send me a name for donor advised funds?
Yeah, the Oregon Community Foundation, right? There's if you have Fidelity account, you can do it in 2 minutes right now. You can set up a DAF. You can move money in, you'll get a tax reduction. But it's your money, but you can't spend it on your stuff anymore, right? You can spend it on charitable contributions, but you'll immediately get a tax reduction.
All right. Hey, everybody, have a wonderful weekend. We will see you here next week. We are going to be, I'll just take 2 seconds here to figure out who our speaker is next week. But as you know, actually, next week is not Thanksgiving. So next week we have Pat Oh yeah, Romy's. Oh, we have the IRA club coming in, so you're going to learn all about setting up self-directed IRAs, and they have a business model where they basically help people do that. So if you recently left Intel and you need some advice on setting up your self-directed IRA, next week will be a good week for you. Have a great weekend, everybody.
Thank you.
Good to meet you, Eric.
Thank you.
I don't know if you're still here.
Thank you.
Thank you. Bye.
Thank you.